Good morning and welcome to today's webinar, Reducing Capital with Integrated Market and Credit Risk, hosted by Asia Risk in association with Calypso Technology. My name is Aaron Walner and I'm the editor of Asia Risk. In the mainstream press, the post-financial crisis headlines have focused on issues of bankers' bonuses and too big to fail, neither of which has been successfully resolved so far. But from a practitioner perspective, the third regulatory trend has been the focus on increasing the transparency of counterparty exposures, and far more material progress has been made on this side. This has seen a move to centrally clear OTC derivatives, while Basel III includes specific allowances for placing capital against market risk as part of the overall credit risk management process. This is a significant change that has not only brought in a whole number of exotic acronyms into risk managers' lexicons, CVA, FVA, XVA to name just a few, but also requires banks to completely change the way they price and manage the credit risk exposures they face. Basel III does not come into place until 2015, but its effects have already been felt, with a number of banks slashing their fixed income and credit books, while liquidity simply doesn't exist for uncollateralized, long-dated swaps these days. While from an Asia perspective, the key issue is that while Basel III allows banks to mitigate their counterparty credit exposures via CDS, there is a very limited supply of these instruments across the region's capital markets, particularly on the single-name CDS side. This is just a couple of the issues which will be discussed, and also how to look at to implement a proper credit risk management approach today. It's a complicated issue, and luckily we have an expert panel joining us on today's webinar who have an unrivaled selection of industry and academic experience. Our first speaker is Dr. Chak Wong, who joined Societe Generale in 2013 as Head of Financial Institutions Asia Pacific. Prior to that, he was Professor of Finance Practice at the Chinese University of Hong Kong, where his academic research interests include the macroeconomic impact of banking and theoretical modelling of financial systems. Chak has extensive experience in the structured products industry, having held a number of key posts in trading and structuring at Barclays Capital, UBS, Goldman Sachs before joining Societe Generale. He holds a DPhil in economics from the University of Oxford, where he was a Rhodes Scholar. Joining us from India is Vijay Aver, who's the Head of Risk Technology for ANZ India, where he oversees risk technology delivery spanning market, credit and operational risk, and is currently driving the implementation of solutions including a high-performance real-time risk engine and cloud-based analytics, an area he acquired considerable knowledge from in the previous role as Director of Portfolio and Risk Analytics with Thomson Reuters in San Francisco. Our third speaker is Dr. Chen Lu. He's the Chief Risk Officer of Ping An Panhai, the hedge fund arm of Ping An Insurance Group, where he's in charge of managing all risks for trading and asset management. As with BJ, he also has extensive experience in the consulting sector, heading up the regional market risk portfolios for both Deloitte and PwC previously, winning Asia Risk Consultancy of the Year award with the latter firm in 2013. Dr. Liu is a visiting EMBA professor at the Shanghai Advanced Institute of Finance, a visiting finance professor of HK Financial Management Institute, an adjunct associate professor of the University of Hong Kong, a visiting professor of Tsinghua in Australia, Macquarie University, and executive director of Risk Management Research Centre at the Asian Institute of Investors. Our final panelist is Philippe Carrel. He's the General Manager Asia Pacific at Calypso Technology. Previously, he was Executive Vice President at Thomson Reuters, leading risk and compliance services through a number of senior roles around the globe. Philippe has an extensive experience dealing securities and derivatives, advising banks and securities companies on trading and hedging, operational and regulatory risks. Unfortunately, Dr. Fred Shen from OCBC is unable to make today's webinar. Before we start, I'll run through the format. In addition to the panelist discussions, there will be a series of polls throughout the next 60 minutes in which we'll look to gain the views of you, the listeners. And crucially, this webinar is intended to be very interactive. On your panel, there's a question bar where you can submit questions, which I'll then put to the panelists. I would encourage you to submit as many questions as possible. All panelists are keen to interact with the end listeners as much as possible. As I mentioned, and also once the discussion has been concluded, it will be available online for the next 30 days to be downloaded. So if you miss part of it, you can come back and listen to the rest of it later. As I mentioned earlier in my introduction, there's been a step change in the approach to market risk over the last few years as part of the understanding of the broader credit risk exposure. And so to start this discussion, I'd like to speak to Chak. He can give an overview of how we've got to a position with dealing with market risk as a purely statistical exposure. So Chak, how did we get from where we were to where we are today?
Well, it actually all started with what we call the counterparty exposure. So maybe to get the audience all on the same page, we can probably start from thinking, how do people used to manage credit risk before? So let's say we lend to 10,000 people. And then we sort of estimate in real life, like what's the percentage people actually will default. Let's say 2%. Then the typical way of doing this is then you provision for 2% of the default amount, and then you just call it a day, and then you wait to see whether it's a good time or bad time, more than 2 or less than 2. So this has been the more traditional approach, and this is what we typically call the non-mark-to-market or sort of the banking book type approach or statistical approach to credit risk. But however, since the development of many of the newer credit risk transfer instruments, especially CDS, then another way of thinking about the credit risk actually is making it like a market risk type. So let me use another example, probably more familiar with the audience, is like you think about the futures of stocks. We can either think about in 3 months' time whether the stock is going to go up or down, and that would be the real life, which is statistical, to see whether the stock is going up or down, to see whether you make money in the futures or not. Another way to think about this is that it's a pure market, meaning hedging approach. So to price the future, what we can do is look at the stock price today and think about the financing cost of holding the stock till, let's say, 3 months' time for the future, and how much money do I need, and the price of the future by no arbitrage, meaning that it will have to be equal to the stock price today times 1 plus the interest in 3 months' time, and that would be equal to the price of the future. So that would be a market way of pricing the future. And similarly, if you have a loan, and the loan, instead of looking at the provisioning of how much it will statistically, how much it lose or make, we can look at the market trading level of the CDS, meaning how likely the market thinks this is going to default, and then you can hedge yourself by buying the CDS credit protection, and you can compute a fair value of the loan or a fair value of the derivative, and this will be the market approach to the credit risk. So maybe to summarize, a market risk approach to pricing the credit risk is by using the market instruments and infer from the market the default probability or the loss, and you hedge as well, meaning that you actually trade the market instrument by removing all the credit risk at the same time. And we come back to this problem over and over again, because for many of the Asia credit, there's no credit instrument, there's no CDS there. And then how do you hedge and how do you price when you're supposed to hedge and you're supposed to price? So this is a very big challenge for many institutions in using the market risk approach to credit risk.
Okay, well, perhaps we can bring one of the institutions at this point. Chern, from your perspective, in terms of what Chak has just mentioned about the difficulties faced in the Asian market from hedging and pricing those exposures, from an end-user perspective, how do you deal with some of those issues that Chak has just brought up?
Well, I totally agree. Chak just brought in a big picture of what currently Asian market looks like. Compared with U.S. market, that we definitely like the whole infrastructure. Now, the one thing actually, China has really started CDS a couple years ago, but certainly because it's like the market interest. So this CDS, even though it's not called the CDS, actually they call the CRMA, credit mitigation contract, so it's something like that. So there's a liquidity. What I'm saying is because the CDS actually serves two purposes. One purpose actually, as it was born, is it will be used definitely for hedging the credit risk. This is given like number one purpose for its existence. A second one actually is sort of like reverberate, like we feel this is circle, like going to the next level. After they're treated, the credit info will be collected. It turns out to be actually I forgot. There's a American scholar has done the research. They got convinced that from CDS market, actually those credit info, including the default, anything, there is more efficiently and fast-paced transferred. So, and also there the info is more accurate. So this info implied from the traded CDS price will be used not only for the credit, also for those OTC derivative, because now later we'll touch upon those XVAs. This is a like hybrid thing, combined about the market risk and the credit risk. It used to be due to this market neutral methodology. You say, okay, you just naively you have those very beautiful world. You don't need to care about this credit spread thing. But now this dream has been broken. People has been brought back to this cruel reality, saying, well, yeah, after the financial crisis, you have to face that. So here, this I would say there's two types of approaches over there. The first one will be follow the Basel III. They will give you the methodology. Also, they will give you the framework. Namely, before you have a very full-fledged derivative market, which you can use readily available tool on the market, you can hedge those risks. You have to build up yourself internally. You have to follow those guidelines from Basel III and about the liquidity, about those OTC derivatives. So this was something. And the second, this is from the internal perspective. And from external perspective, that will be for each country and sovereignty, its regulator have to take the spearhead, take the leading roles and promote and establish and compete the market by establishing all those necessary critically important hedging instruments. As the example I mentioned in China, it has been there. Actually, it is the second derivative they have constructed in China, but it is never reached the goal they expect to reach. So at this time, the trading volume is pretty small, so the liquidity is not that good, so it's not widely used. Actually, to a lot of people, they didn't even know the existence of that instrument. So from my perspective, at least from the approach, we have to take both internal, external, like two sides.
Okay, so we've got kind of a split approach depending on the liquidity and the available of instruments. I mean, Vijay, from your perspective, in terms of setting up the infrastructure to deal with this, Chern has just mentioned there's a kind of two ways of dealing with the issues that are thrown up. How do you manage the pressures of these two different approaches from a kind of a systems implementation approach?
Well, first of all, it's always a big challenge if people are looking to see a unified view of market and credit risk, right? I mean, for many reasons, both historical and practical, market and credit risk have often been treated as if they're completely unrelated sources of risks. The risk types have been measured separately, managed separately, and economic capital against each risk type has been assessed separately. And development of credit risk transfer markets and the moves to mark-to-market accounting for portions of held-to-maturity banking book positions, however, they've blurred the distinctions between them and have raised questions regarding the approaches that treat the two types of risks separately. There's significant diversification benefits to be reaped from integrating that. So one thing that we've been trying to do is to see if we can come up with a unified approach by coming up with possibility of an integrated market and credit risk model. And one of the things that we've tried is estimating our mark-to-market portfolio value distributions using Monte Carlo simulation. We've achieved a fair amount of success over there, and we've also derived a closed form expression for conditional loss rate of asymptotic portfolio of credits. And we've also put together a ratings migration framework that incorporates the value effects of market risk and of non-defaulting credits. So what happens then is, in terms of our infrastructure, we've set up a high-performance grid that captures all of these and is able to compute Monte Carlo simulation-based exposures and provide economic capital calculations and provide a unified framework and a unified dashboard that integrates both of these, and users are able to seamlessly select modules and form customized dashboards that gives them a unified view of risk.
So, Vijay, from your perspective, in terms of using kind of the Monte Carlo approach, does that mean you can make up for perhaps the absence of liquidity or the absence of some of these instruments? You can model these risks even without some of the underlying instruments being available?
Well, not really. The only advantage that Monte Carlo offers is the ability to perform calculations with greater accuracy. There's obviously challenges in terms of establishing an infrastructure that can support a Monte Carlo simulation exercise, but it does have its downsides. It doesn't necessarily account for the absence of liquidity, though, and that is something that certainly has to be accounted for.
Okay, thank you. I'd like to bring Philippe in at this point. From your perspective, we've heard some of the other panelists look at some of the challenges facing the industry, and particularly on some of the lack of instruments available. From your experience with dealing with firms implementing these kind of approaches, what do you think are some of the solutions to the problems that have been raised?
Right. So we have market and credit risk, and the need to have an integrated view of it, as Vijay just put it. And it's absolutely true what he said, that in the past this has been looked separately, just because we all did it by the Basel book. And page 1 was on market, page 2 was on credit, and therefore we took those problems separately. Then the global crash arrived, and for the first time, now the regulator come and want to give an incentive for you to integrate market and credit risk. And the first, I would say, baby step into this is probably the Cba, which is recognized as a way to mitigate your credit risk and hence reduce your regulatory capital charge. Now, I think we should consider 2 case scenarios. Market risk is actually related to liquidity, as we just said, and credit risk is related to volatility, and especially since most of us calculate the credit risk based on the merchant approach, we will take its variables into volatility data. Now, on the day-to-day business, when business is as usual, when we're not facing a particular adversity on the market, it all consists of measuring this risk together or separately, mitigating them, and adjust according to the policies of the bank and according to the regulatory rules. So that is a way to obtain our regulatory capital. And again, Basel starts to encourage mitigating those risks with CVAs and other forms of integration of market and credit risk. Now, on the tail event day, on the crash day, this is no longer going to work, as we all have learned in a difficult way. Then only scenarios can actually work in terms of integration. And now we're not talking so much about regulatory capital, we're talking about economic capital. How are we going to weather a massive crash or an extended period of adverse market? Then a market shock actually impacts the volatility, and that volatility surge impacts the credit risk, and that credit risk impacts the liquidity, which in turn impacts the market prices as well. So now the order in which those variables are playing one another is completely changed. And here is the problem, is that we have yet to derive a methodology to see how those 4 areas, market volatility, credit, and liquidity risk, are actually playing together. And obviously, there is no rule for this. So far, it's only managed with scenarios, and the problem here is that most scenarios I have seen in my career are rooted in history. And as Avinash Persaud would put it very nicely, the future is not rooted in history, the future is a reaction to the present. The second issue is what we call cross-asset. So far, what we call cross-asset measurement of market and credit risk is merely to add an FX layer on some other assets like equity or fixed income. The true cross-asset measurement of risk will be achieved when indeed we have a model or a methodology. It doesn't necessarily need to be entirely quantitative. A methodology to see how those 4 aspects of risk are working together. So what can be done for this? What I see is being undertaken about this is to really dismantle the IT of a financial institution and decompose the trade workflows into data queries and independent processes. I'm not talking about breaking silos that we all know that it's necessary but impossible. It's really decoupling the management of data, pricing and valuation from each of the workflows that go from a core banking system all the way to pricing, evaluation, hedging, and eventually accounting and regulatory reports. So this is achieved by considering all the processes a financial institution needs to go through, and considering that each of those processes, so for example in core banking or in trade executions, in position keeping, in portfolio management, each of those processes generate risk and generate compliance needs. And the action, or I would say the endeavor, of decoupling completely the data management and the exposure and pricing and valuations out of those processes is in itself the integration of all risks together.
Well, I think that's perhaps a question coming from the audience. That might be a suitable time to put this to the panel. So one of our questioners, and I think just touches on the point that Philippe was touching on there, was talking about how you implement an enterprise-wide architecture, and to talk through some of these kind of risk management approaches that Philippe was describing. Then, I wonder if I could sort of throw that back to Vijay as perhaps the first member. This has come from a risk manager, an Asian-based risk manager. We'll keep these anonymous. So the first question has been, during the implementation of an enterprise-wide risk architecture, what are the common challenges the company might find? So this is a process that you've been through, Vijay. So from your perspective, when you were kind of implementing these kind of market risk and architectures from a tech perspective, what were the main challenges that you faced, and how did you overcome those?
Well, there's multiple challenges. There's ensuring that there's a single source of truth in terms of the data that we have. If we are also looking at quantitative analysis, there's going to be time series and time series of data. So it's going to have to be put in terms of understanding what's the data model that we're looking for, what's the data strategy, and how do we want this data to work for us in its effective best. That's one of the key things to understand how best we can derive analytics out of the risk data that we are generating. The second is understanding what kind of computations that we're making, what level of computations that we're making, and what's the kind of machinery that we need to make, that we need to leverage in order to compute the numbers that we're trying to crunch here. For example, I did again mention about Monte Carlo. The other thing that we've also done is leveraged cloud services and put analytics on the cloud, where now each of our requests are processed by our HPC high performance grid, and then the analytics are now available on the cloud, where people can just access each of these things based on their custom set of inputs straight off of the cloud. So again, there's multiple challenges in terms of understanding whether or not a cloud-based architecture is best for what I'm looking for. I would say it's best to start small and start with understanding what your data strategy is going to be. Where's the data stored? How is it going to be structured? How am I going to be best leveraging what I have right now in order to produce the insight that I'm looking for from each of the data components that I have? It starts from there, and then based on how you want to visualize that, do I require a dashboard? Is this going to be mainly reporting based? How am I going to be outputting this data? Am I going to be producing some quant models based on that? It's all, again, then it becomes a decision of what tools am I going to be using, what methodologies am I going to be using. According to me, it starts first at data. Once you get the data part right, everything else falls in place.
Okay, and this also touches on what we were talking about earlier about some of the underlying instruments. How do you get is there the enough data available to construct these kind of approaches?
Well, there's never going to be enough data. There's never going to be enough data, but it's really not about what's the ideal state of architecture. It's about what we have right now and what's the best that we can make use of what we have. One of the challenges that we had initially was also the absence of our own custom pricing engine and valuation engine. We worked around it. We had a vendor solution that we hosted earlier, and right now we've built our own. And so it's really about understanding what you have and what best you can make use of. I mean, I know it's a generic answer to a question, but it's not necessary that you need to be able to have every instrument that's out there and be able to price every instrument and understand how to compute risk for every instrument. Start with where you have and build on top of that.
Jack, can I bring you in at this point? I mean, do you agree with Vijay's points?
Yes, to a certain extent, I do agree that data is very important, but I believe that something more important, actually, especially for a very senior manager, is also having a good understanding and about the impact from an organization perspective of the different types of things we discuss. For example, let me just give a very brief example. From accounting point of view, that is required that it has a fair market price for any type of instrument, meaning that when you look at the instrument and when I look at the instrument, when we trade with each other, we have to arrive at the same price from the accounting regulation point of view. Meaning that if you charge me CVA, then I should deduct what I call DVA from myself. Meaning that if you think that the $1 that I owe you is worth a bit less from my point of view, which is CVA, then you should think about deducting the same amount from the $1 that you owe me. So now, however, from a banking capital perspective, this is computed very differently, and what you call your own credit, meaning that when you are deteriorating, you can earn a profit that cannot be marked towards your capital. So all this, from organization perspective, just thinking through straight, is very important before we go ahead to implement almost anything, because you will find out that whenever you want to compute a CVA or DVA or anything like that, 6 banks probably have 18 different ways to do it. So and you ask the employee themselves, they probably can come up with 1,000 different ways of handling that. So I would probably say that it is very crucial, from my experience, to have senior management actually having thought through this a bit more, to understand a bit more, rather than go ahead and do the implementation.
Okay. We're going to move on to our first polling question in a sec, but I just wanted to, we had another interesting question coming in from this time from the US. And someone's obviously a night owl in the US listening in, and it's just a question. And I think it's we've talked, the whole concept of this webinar is talking about how market risk is now being formed and how you value it as part of the whole credit risk exposure. And someone has just asked the question: well, given that banks still have to report credit risk RWA and market risk RWA, both of which have multiple components, how do you separate those two out when you're also calculating them as part of the credit risk itself? Perhaps Chan, perhaps I could ask you that question first.
Actually, from the banking perspective, well, given the current job, I'm more on the trading side. Can I just give you a little bit different example? This is actually the real example when I step into Ping An, Panhai. So we do, I think, I also remember the notes with the block trade. So block trade there, this is sort of like, in China, it's sort of like OTC. In US, is exchange traded NYSE second floor. There's a, designated staff that handle that. But in China, this is sort of like, the OTC. So there, we got exposure. The exposure we got is simply because the way it's transacted. So it's simply because when we have the first settlement price up to the last day, we have two prices. So here, if the transaction price during the intermediate period is what we call the VWAP, and then we have a discrepancy there when the first transacted price versus the actual price. So the difference will depends upon your market position. If you gain the market, that that means you will get naturally you will get this EAD, the credit exposure over there. So this is a sort of like from that example. Before we adopt this combined approach with credit and the market, we just separate. We say, hey, we got those type things. So the credit side will purely adopt the ARB. Look at the mitigation. We get the exposure. We get all those weighted RWA type of approach. Then we switch to the market. We look at there. We calculate share price as a variation for the last 3 months or half year. So we add them up. So we go through different department. We go through the market risk department. We go through credit risk department. Now when I step in and say, hey, well, look at this part, because this is the market risk, actually will induce the credit risk. So we need to, integrate them, combine them together. So we adopt I'm going to call it simulation there. I just totally agree with VJ. That's very effective because it doesn't have a fixed, closed formula to calculate price. So we conduct this simulation. Then we calculate, given certain percentile at that stage, at that level, the tail risk. If the market is, you gain from the market perspective, you share the transaction price is way better, then that means your counterparty will owe you money, so you have this, counterparty credit risk. Then we just combine this. So we have these two things. Well, obviously, this is a sort of like the triangle, two sides. The sum, the length, two sides is always bigger, larger, longer than the one side. So from that perspective, for this specific sample, we reduce the capital. Actually, what we call put aside capital to guarantee this trade. So this is from my perspective. Coming back to the original topic, I think the original approach, I will be said, is a silo. It just look at the credit, look at the market perspective. Also, the approach is not that risk sensitive. That means you have those, grade. So grade is like put a lot, possible scenario to cram them into one. So they want to have an average. So this average, it depends upon your bank's holding, your portfolio, your actual positioning. So sometimes probably you can gain something from there, like what we call regulatory capital arbitrage. But a lot of the time, this average, this market-wide average, will be pretty conservative. That means most of the time you are at disadvantageous position. So here, when we look into those actual positions and we kick off those was complicated simulation, so we can introduce a lot of mitigation procedures or tools, reduce the overall the capital. So this is a thing actually we are doing, and a lot of banks are doing overall in the Asia area. Last year, actually before I moved to Ping An, I have a few banks in Hong Kong and China area. They are doing similar things too. They look at the whole original RWA approach. Now they look at this combined. Well, similar good. They just doing that. They just pick up a few very high rate large trading volume products, and they start with that, so they can do some experimentation. They see, okay, we have the things used to be in bank trading book or banking book, but given the original regulatory capital calculation methodology, then swap into this new regime. We adopt into this SVA, all those type of approaches, plus more complicated simulation, just how much we can save that. So this is I think a lot of banks are doing, and I think more banks are willing to do that. It's based upon the statistics we collected, and the trend is so a lot of banks are willing to do that because they see there's a good way and effective way to reduce the capital. There's a 1 + 1, and just a final number is like some magical correlation effects play the role, so they can reduce overall the capital usage there.
Okay, thank you, Chen. Thank you. We're going to move on to, and also thank you very much for the questions that have been coming. We've got some we've had a couple more coming, which we'll come back to after our first polling question. So I'm just going to start the first polling question, and I think probably know the answer to this before we start. But I think it's a question talking about are there sufficient instruments in the Asian markets to hedge some of the credit exposure that Basel III provides incentive for? So we've got 3 separate answers available for that, and the poll will be live for the next 30 seconds. So in terms of the panelists, I mean, we've kind of touched on this. We've touched this earlier, and also have Also, our next question is come from someone asking about in terms of how you price some of these credit exposures, which I think the answer to that question will kind of link in very much to the results that we get for this poll. So I think we're just coming to the end of this. So if the technology is working. Right, I'm just waiting for that to come through. So the reason why I'm waiting for while we're waiting for the poll results to go through, we've had another. We've had a question come from an Asian bank based in Asia, and the question is in terms of the acronyms that I mentioned earlier, sort of and in terms of how they approach the credit risk and market risk, how are they being priced into trading? And certainly when I came out to Asia a couple of years ago, there was a big divergence between the banks in terms of how they were actually pricing in the market risk of credit exposures into the structures they were offering. My understanding is that this has changed significantly in recent years, and it's pretty much across the board. And perhaps I'll ask that question, Jack. You seem an obvious person to respond to that question. In terms of, if we're talking, sort of the CBA, DBA, XBA, etc., is that being priced in across the board by all active banks now in the Asian market?
I would pretty much say that any bank that implement the Basel III directives have to actually price it in, because it is actually part of the requirement to price the counterparty credit valuation adjustment. There are still some banks that most of the people that are actively trading in the market, you have seen that already. Now, probably the CVA is not very controversial. So everybody do that. The DVA, meaning that whether you take into account of your own credit, is much more controversial, because some banks do, some banks don't, and some banks sort of still looking at it. And the third topic, which is the FVA, meaning that you have to take into account your funding. And here, actually, the funding is whatever that is actually different from the DVA, because when you price the DVA, you're using the CDS. But however, the bond CVA, that is actually additional spread there. And this is actually can create differences when you need to, for example, when you buy an option, you need to fund the option, and the funding of the option is not necessary. You're not necessarily funding at your own CDS level, and this can create a very different result. This is probably not. We have not seen we've seen extremely controversial discussions, and we have some banks do it, some banks don't. And probably the last one is that for most of the advanced banks, they are actually also looking into also the collateral, which is part of credit risk as well. How to look at the collateral differences when you collateralize in dollar and you collateralize in yen. It can be very different because of the funding currency, which is yen and versus dollar. And this we haven't seen. Sometimes we still see some discrepancies, and some banks may not actually have all this necessary setup and system to check every single one of the CSA and the document and collateralized document. So I think for CVA is no controversy. Everyone doing it. For the other ones is difficult. I think that's a summary of the situation now.
Okay, difficult. So that neatly kind of goes back into the first poll. So we've got the question was, are there sufficient instruments available in Asian markets to hedge some of the credit exposure Basel III provides for CBN and others? And so it's quite it's a very clear result. So 66.7% have said that they have some of the instruments available in the market. The next largest 20% was I can't hedge any of my credit exposures, with 9% for I can hedge most of my credit exposures, and just 3% can hedge all of their credit exposures in the market. Philippe, from your perspective, do those results chime with what you've experienced with the institutions that you've spoken to?
Yes, very much. And what we hear in Asia is the answer is no. There's not enough financial instruments available to hedge as they wish it would. In particular, that was mentioned, the lack of CDS generally available. Some other issues also came from Basel latest requirements, especially in liquidity with the liquidity ratios. In some countries, the liquidity is not found. The most important liquidity pool is not found in the usual type of bonds and fixed income securities. So there is definitely a national adjustment to do here for some of the countries of Asia.
Okay. Thank you. So now we've talked about some of the kind of the valuation approach and what's the background and what Basel actually is requiring firms to do, and perhaps move on to some of the more practicalities of it. All this calculation, all this modelling requires a significant amount of computing power, and also integrating the results into the systems themselves. And so starting from kind of perhaps. There's a significant amount of work that's involved in doing that, and kind of Vijay, this seems to your kind of you're the expert on the kind of systems implementation. I mean, from your perspective, what are the main starting points? How do you start the process once the decision on the valuation approach has been put in place? How do you start upgrading the systems to meet these requirements? How does that process start?
Well, I mentioned before, the first point, key technology drivers, if you really want to achieve that, enterprise architecture leverage, is literally create one system of record for critical data, and make sure that you have integrated packages that meet the functional as well as the integration requirements, implement an appropriate integration strategy that reduces complexity and reconciliation, and make sure that the systems are designed so that the architecture is scalable in terms of increasing the size of the system to better handle, more loads, and it's flexible enough. But, in terms of best practices, right, one of the things to note is that the architecture should provide an enterprise-wide consolidated view of market risk and credit risk, because traders need this information to make good decisions. Also, I would say physical and associated financial hedge deals for related commodities should be on the same platform. Obviously, that enables efficient consolidation of related positions, helping traders make better choices there. Related commodities should be consolidated on one platform without losing the physical nuances of the commodities and their scheduling needs. Invoice charge calculation for each related commodity should be drawn on the trading and scheduling platform. These are typical challenges that, we've talked about how systems are so siloed, where we're really not talking about how they talk to each other and how we can achieve an enterprise-wide strategy, right? One of the key things is that whatever we design, the architecture should enable straight-through processing. It should literally be low-touch. And integration points should be handled by automated interfaces with proper validation to ensure data integrity in both systems, eliminating any manual data entry and reconciliation. It should ideally be designed to implement an integrated view of supply and trading, consolidating positions, exposure, and portfolio across supply and trading. Those are some of the things that I can think of in terms of developing a holistical enterprise view, keeping in mind the business drivers, keeping in mind the ROI that we're looking to achieve out of the system, and by adopting some of the best practices that industry leaders have adopted.
Could you perhaps just give me an example of how you switch from, you talk about going from a silo-wide to an enterprise-wide view. Could you give a practical example of something that you've done that's enabled an enterprise-wide view to be taken where previously it was kept in a silo?
Well, I can give you a very, one of the things that we did was, the accounting and financing, and the accounts payable, general ledger, basically the financials, as well as our market and credit risk systems were completely siloed. What we did is we provided an enterprise-wide consolidated view both of market risk as well as credit risk, and we brought in the financials in there to basically come up with a single unified data model that integrates all of these things, and allow for dashboards that custom pick each of these modules in there, and then they can use that to perform their slicing and dicing right there on the screen.
Right. And so, Philippe, from your perspective, are firms tending to move towards this enterprise-wide approach? Is that gaining currency?
Yeah, and they're all going through the same type of efforts that we hear Vijay is going through, and this is really the right way to go. Now, these integrated views, they are still exposed. They are still passive. This is after trade, after fact. The future is really to make it active. So just like systems were the center in the past, and then you were messages, so that systems could talk to each other. Now it's all data-centric. It actually all revolves around the notion of counterparty data, instrument data, pricing and valuation. So what I see is being done, really actively done, and sometimes those programs are huge, is to create a data hub so that someone could be accountable for it, so that you could engineer client-centric strategies out of these hubs. And then you'll see what you need to engineer those client-centric strategies, whether you need some CRM system, whether you need some core banking system, some position-keeping system, whatever the system, it all revolves around the data. The second point is the regulator is after everyone now on especially the notion of governance. So when we talked about integrated risk management as per Basel III, we're talking about market and credit risk. You will see in the future some kind of Basel 3.5 or Basel 4, whatever we call it, where most likely the regulator will now incentivize to prevent on governance risk, fraud prevention, money laundering, that sort of things. And how is it possible to achieve this and integrate those kind of surveillance to the process and the trade processing chains as we know them? It will be, this time, absolutely mandatory to decouple the data management from the system. And that is probably what we will see in the future.
Okay, which I think leads neatly into our second poll question. I think, as you mentioned earlier, there's a significant kind of IT requirements in order to meet these increasing regulatory and business requirements. And so it's just a very simple question in terms of, has your company started an IT project for regulatory capital optimization? It's a nice yes/no question. I'm guessing this is going to be. I'm interested to see how the results go for this, because it's something it's a long-term process, and you need to sort of plan well ahead. But then I'm guessing a lot of people will wait to see if there'll be any changes to the kind of the regulatory framework. So we'll just wait for the next day. While we're waiting for those poll results to be collated and to be finished, and now the next part of the discussion, we'll kind of look at how the new regulatory framework is implementing and impacting the kind of product selection, and in terms of, and I think perhaps Chern, if I can throw this question to you, I'll just get the poll results, and it's, one second. Yes. All right, so it's roughly 50-50 split in terms of half the people, just over half the people have gone an IT project, while just under half are kind of waiting. So Philip, be surprised by that? I mean, you accept more people? Does that sound right?
Actually, yeah, it's only based upon my consulting experience, yes, I've dealt with quite a few banks in Hong Kong and China. Yeah, well, you see here the part of the dragging forces is the front investment for a new IT system, especially the thing about for the trading book, those VAR. We have heard this rumor about conditional VAR or CVAR sort of have dangling around for quite a while. Say, hey, we have to upgrade your system. But here, I think the reason why we see the half of the bank, so still stay put, didn't take any action. I think it's from the budgeting or the initiative purpose. They're afraid they sort of like they want to look for more clear signal from the regulator perspective, and they don't know when they pull the trigger. They know they will be there, but I think they don't know when. But given the other half, they sort of like take a more proactive role. They know they have to take this part, so they are willing to put down some effort. I don't know, it's like upgrade your general ledger system, as Wade mentioned. I have helped a few Southeast Asia bank. They are doing that too. Upgrade the core accounting part, the system, just simply because a lot of those infos will be used to be fed into either market risk side or credit risk side. So this is overall. The third aspect I would like to touch upon upon will be for those new type risk, they're not clear because you see, you want an IT system, then first thing you have to have those business requirements. So that you have to lay down explicitly because you are going to implement this system, use the IT, the system, the database, or what's the length, sort of something like that. For a lot of those new type risk, they didn't understand that very well, like the CBA, FVA we touched upon earlier. So they are a little bit hesitant because if later regulator changes their mind, they sort of like tweak the actual formula or regulation a little bit. That means that everything you have put into this system, upfront, that will be totally, drained over there. So this is another hesitation. So overall, I think, this is given the current, relatively quiet period because we're waiting for the next one about the Basel, I don't know, like early 3.5, then we will go to 4. It will be anticipated a lot of those the fundamental change, the trading book, then you have to change and, upgrade, revamp your system, including data. Probably a lot of the new data will be needed, so you have to probably have with different, department like, Vijay mentioned. So the interface between the credit side and the liquidity side or the ALM side should be constructed, should be connected. So you have those data reconciled, and at this time, as far as I know, their data collection frequency definitely will be the first roadblock because the market data will be collected on a daily basis, and then relatively speaking, on the accounting side, it will be then weekly a little bit slow on the banking book side. So this is a discrepancy, then we have to talk and, put a lot of preparation at the front. So all those add on. So that's sort of explain why we're going to split evenly, half a half. So very people think the situation not that clear and that they want to get, more certain situation, then they want to pull the trigger.
Okay. So we're waiting for a bit of certainty on the market. We're talking of certainty. An excellent question come in from a head of fixed income who's based out here in Asia, and simply asks, why is Cba pricing so different between banks? Chak, I'm going to throw that question to you first. So someone said that Cba pricing is very different between banks. Why is that?
Well, maybe we don't need to look at a very complex derivative. Maybe let me explain this using a very simple example. Suppose that, let's say, Bank A owns Bank B $1. So it cannot be simpler than that. So Bank A need to pay $1 in 1 year's time to Bank B. So now so let's look at how all these things are priced. Okay, from B's perspective, this is an asset. This is a loan that is actually, or a bond that's actually lent to A. Now, when pricing this, obviously we need to take into account the credit spread of the aid into account, and this is called a CVA, right? Now, however, there are a little bit of interesting thing here is that, okay, now originally I need to lend that $1 from Bank B to A, and Bank B obviously need to raise funding. So then, how do you take into account of that, or do you take into account of that? And also that. Can you assume that you get some benefit from your funding, meaning you borrow from other people's money? Can you assume that you can default and hence price the benefit of not paying back the funding to, let's say, another person that you borrow from, which is, let's say, called Bank C? Okay. Now obviously, the borrowing can be collateralized or uncollateralized, unsecured funding or secure funding, and so on and so forth. And so all these complex issues, meaning whether you should fund yourself and whether you can assume that you can price the DVA in there, even in the pricing of as simple as like $1 in 1 year's time, can actually have many different answers. And more importantly, this is a very schizophrenic environment we're living in. The accountants, the IFRS in this part of the world, require you to actually price in for all transactions, especially when a transaction is more complex than owning $1. Let's say it's a swap that you can actually go up or down. Require to record a bilateral CVA, meaning a bilateral CVA, meaning that it has to be priced in that the other counterparty can default and I can default at the same time. Okay. Now, for this is what accountants require you to do. However, the regulators, which is a Basel III regulator, forbidden the people from actually pricing in the DVA. And now, then who should you listen to? The accountant, which is what regulates your public account, that what you have to report in your end report dictates you on that, or you should listen to the regulator. Now, and obviously the regulator determine your capital requirements, so when you're pricing the capital, how much capital you require, you cannot price in the DVA, and so on and so forth. So already you have about 5 or 6 different answers already, and of course then there are different approximations for more complex instruments, because in order to price all this FVA and so on, you need to do a Monte Carlo simulation to compute the price of the instrument, and then you need to do additional Monte Carlo simulation in order to price the capital part, and especially the funding part. Now, there's something that even more trickier than this, because the CVA is a market risk itself, and as a market risk, it clearly has a VAR, a VAR, and the VAR actually will cost you capital. Now, you need to compute the VAR of the CVA in order to compute your capital, and this becomes a Monte Carlo simulation on a pretty complex one already. And some people look at this, some people don't, and this is additional source of differences for all the different banks.
Okay.
So very complex.
It is very complex, but I'm going to try and reduce that to a very simple question if I can. And Beryl, we're coming to the last few minutes of the webinar, so if the panelists, if you could answer this question very quickly. It's just about in terms of, there's 2 different standards with the approach to the CBA, the regulatory standard and the accounting standard. Churn, does that cause problems for you, that those 2 standards exist? And if so, how do you resolve those?
Well, first let me say that you just recall where the CVA is derived. Actually, it was first suggested by accounting side. It's putting into this as additional adjustment. There's a few adjustments over there, and they propose idea. But from the accounting side, they never specify how you should do that. They just say you got to take into those consideration when you have this, mutual sort of like exposure. It doesn't mention about the derivative, something like that. But later, the Basel picked this up. They laid out the specific rules, and as Jack just mentioned, they gave you actually explicit formula. They have an advanced method, preliminary method. So based upon your position portfolio, you can calculate the actual capital. So there's a sort of difference over there. One, they just give you the framework, and then now currently we have to follow. Basically, we have to do this market CVA, follow that, and there's a few considerations. I totally agree with Jack mentioned over there, the technicality over there, because based upon that, there's a 19 collateral and the CSA, all those nitty-gritty details you have to take into your consideration. That's where convoluted this whole process. It's not like give you a mathematical formula or quant formula, then you got the data, you put into Excel, you get number crunched, and that only probably won't work out for the swap type. Actually, we have done that. But for consider from portfolio perspective, then these things can be really promote to the next level of the complexity. That's sort of differentiate this two from the idea. Some idea accounting, they just enforce you. Okay, you have to consider those type risk factors additional. Based upon in addition to the provisioning, the accountants always enforce you to do. Then this is they sort of a step out of the arena from accounting world, now moving into this risk arena. So here, I think this is a boundary. The approach will be a little different.
Okay. Well, I think that's a perfect segue into our final poll question, which is our final poll question is asking whether the Basel III approach to the risk-adjusted returns on capital provides economically valid results. With the answers all of the time, some of the time, or never. And I just said from your Philippe, as we're waiting for those results to come through, what do you think the answer is going to be? I mean, what's your answer to that question? Do you think it provides economically valid results?
If there are risk managers at the other end, I'll be very surprised if they will agree that the new approach in regulation is going to get some level of convergence between economic and regulatory capital. What we all see, and I used to be sitting at the Financial Stability Board in Switzerland, and I had a whole panel of regulators, and amazingly enough, they would agree with this, is a dangerous, and I mean it, dangerous standardization. Some of the lessons have been learned, and especially the integration of market and credit risk, we talked about that. But the lesson of standardization and driving the whole of G20 now towards a similar application of similar models relying on assumptions, like was just said, the Monte Carlo and the Monte Carlo, themselves assumptions have been resulted from model calibration. So how do you calibrate a model, actually? You take some bounds, worst case scenario, best case scenario, and that sort of things, and then you run statistics. This is how you calibrate the models. Now, when a model relies on another model, you have assumptions relying on other assumptions. Next thing you know, you're losing control, and the day you realize you have lost control is the day that actually the market is teaching you that. So that will be my answer. Yes, but we should really be wary of standardization, overly standardized approach.
And perhaps a quantitative approach.
And entirely quantitative, of course, as you have seen. A quantitative analysis on just about everything. Okay.
Well, we've just got the results for the poll question. Does the Basel III approach to risk-adjusted returns on capital provided economically valid results? And it's a clear winner. 87.5% of people said some of the time. Actually, I'm quite surprised. Never is 9.4%, and all of the time 3.1%. So 3 times as many people think it's never provides results as think it provides valid results all the time. And overwhelming majority of people, virtually, that's almost 90% that say, some of the time it works. So I think it's cool, which I think also kind of ties in with sort of Philippe's comments there about sort of the problems from relying too much on perhaps one particular metric. Now we are coming on the fact that we've run over time. So just coming to the last part of the panel, I'd just like to give a chance to the panelists to make a couple of brief comments. And Vijay, I'll perhaps ask you first, and the rest of the panelists, if you could just sort of follow Vijay with a couple of final thoughts. Vijay, given that the complexities that we've discussed here, do you think the industry is on top of managing the issues that are thrown up by integrating market risk into credit risk?
Well, not really, but then, it's important to develop that holistic enterprise state. It's really important to define that future state that adheres to the tenets of transparency, efficiency, and meets the business needs of what we're looking to achieve. It should define a viable roadmap, giving incremental value to the business, especially in risk management. And that's something that we're lacking, but it's important to think holistic, think macro, and think about how we can leverage everything, and instead of cross-componenting stuff, just create some holistic components that can be leveraged all across.
Sure, and same question to you. Is the industry ready?
I would say actually there's 2 perspectives. Mentally, I think at least from what I heard about it, yes, they know there's a lot of things will be coming. The more type of risk and the more stringent rules in terms of capital risk, economic capital and risk-adjusted returns. All those fancy ideas will keep be thrown to them. And the second is from the reality check perspective. I would say going back to that 50%. So that probably just explain a little bit. Yeah, they have to face reality. Some operation they have to push out. then they have to say how much they can spare out in order to invest in this future change. But now here's the timing issue. You say when you anticipate this, the new rule will be in place. So if you think you're okay, well, you still think it should be a period of time. So some of the banks actually are thinking in that way. So that's what I explained the poll result. And so this from my answer, that would be yes. I mean, from the anticipation, from the mentality perspective, everybody I think is knows that should be the way we're going to heading for. And at the same time, they have to manage the day-to-day operation and manage their budget in terms this year, next year, sort of like balance out.
So Jack, the industry is ready. It's just a question of timing. Do you agree?
Well, they have to ready whether they like it or not, because when the regulator actually comes in 2018 and 19, everybody will have to be ready. So, but okay. However, I think in Asia we have a tremendous lack of talents to manage it. So I'm putting my professor hat on. Is that I think that we just don't have enough people to deal with the whole ramping up of the regulations.
Okay, so Philippe, what do you agree with those timing? More people? What's the outstanding issue?
Of course, the industry is ready to comply. It's not ready to manage risk. We talk about integrated risk management. I think the management of risk will be integrated when it will be shared by all people. Each time we talk about breaking the silos, we think of systems and IT processes. What about management processes? What about chains of command in terms of crisis especially? I think the financial industry has a lot to learn from other industry. I'm thinking about insurance or the prevention of pandemics and those sort of things. Those processes are actually a long way ahead of the financial industry.
Okay, so good progress has been made, but there's still perhaps a lot to be done. Thank you very much for listening to today's webinar. I'd like to take this time to thank our panelists, who are Vijay Avila, who's Head of Risk Technology at ANZ, Dr. Chen Liu, the Chief Risk Officer of Ping An Panhei, Dr. Chak Won, who's the Head of Financial Institutions for Societe Generale for Asia Pacific, and Philip Carrel, General Manager, Asia Pacific Calypso Technology. This whole recording will be available online for the next 30 days. And once again, thank you much for listening, and thank you once again to my panelists for joining me today. Goodbye.